I still think that Miami is it is one of the Sunbelt success stories that has not had this whiplash effect that that some of the other places have had. It's getting a lot of supply and it's doing great in terms of rent growth. There's like nothing you could do.
I agree. Miami is not only a fun place to go and visit. People like to live there. It's also very tax friendly, and I think there's some supply constraints. They're not as building nearly some of those other big boom Sunbelt metros, Matt, as we've noted. And they've really kind of really been able to kind of stay ahead of it and continue to perform. And not every market in Florida has continued to outperform. Matt, but I got to stay on the Midwest.
Totally.
Switching over to the Yardi Matrix report since you brought it up. This is a quote from the Yardi Matrix report for February. Multifamily report. It says, meanwhile, low volatility Midwest metros in Indianapolis with 9% growth, Kansas City 7.9% growth, have cycled to the top in part because they remain inexpensive and have not increased inventory as much as their high growth Sun Belt peers. New York and Chicago are also displaying resiliency as attractive cultural centers where people want to live, if not work. So it's, again, as an investor in the Midwest, this is all great to see, with the Midwest claiming 3 of the top 5 spots in the Matrix top 30 metro list for year-over-year rent growth. Again, I mentioned Indianapolis, Kansas City, Chicago, also on that list. And so even from just on a month-over-month basis as well, we're seeing a lot of Midwestern markets do quite well.
Yeah. It's also interesting kind of looking at the lower end of the rent growth lists, both for CoStar and for Yardi Matrix. Now, Yardi Matrix has let's see, I'm just going to look at for month over month. They have Las Vegas, Seattle, San Jose, Phoenix, Orange County on the lower end for their month over month, and then for their year over year, it's Las Vegas, Phoenix, Austin, Atlanta. A lot of those are the ones that are getting new supply. Some of them, it's not like perfectly correlated with the amount of supply that they're building. And so that makes me think that a good portion of this rent slowdown is this kind of counter reaction from the runaway rent increases a couple years ago in many of those markets. And Yardi has an excellent an excellent chart at the end of their report where they measure the amount of construction that is forecast, or I'm sorry, the completions as percentage of total stock, and also their year-over-year rent growth. And you can draw a rough correlation, but it's not perfectly correlated when it comes to new supply and the rent growth.
Is this the chart you're looking at, Matt, looking at employment and supply trends with forecast rent growth?
Yes, exactly. Yeah.
Yeah, exactly. So just as you said, I like looking at, what the job growth is. And then, so that's an indication of potential future demand, creating jobs. People want to move into where those jobs are, typically leading population growth. And then what's supply look like? How much we're completing as a percentage of total stock? And then, all right, taking that together, maybe let's look at maybe where rents are going to go. And then where are we year over year in terms of rent? Again, Indianapolis with 9% rent growth year over year. They're forecasting 3%. Job growth is forecasting, that's the 6-month moving average as of December 22, 2.5%. Then completions as a percent of total stock as of February 23rd, 0.7%. So good demand, Matt, low supply. It's a good recipe for success, in my opinion. But, the downside to those numbers, again, just picking on Indianapolis now, is the job growth, while positive. And, let's see, I'm not sure if they have the average or not. I don't have the average here, but probably just at the average, maybe even below average, compared to New York, which is, 5% job growth, or a Dallas, which I believe is topping the list at 6.5% job growth. But that is also relative to, supply completions percent of total stock. But Dallas is delivering, 2% versus Indianapolis 0.7, or a market such as Denver with only 3.5 year-over-year job growth, building at 3.8% completions as a percent of total stock, compared to get the Indy's 2.5 and the 0.7.
Yeah. The big pullout, and I'll pick on Austin now. Now that we're done with Indianapolis, is they're building 4.9, the leader of the new supply coming online, and they're the third lowest when it comes to rent growth. Even though they have 5% of job growth, which is among the leaders in this list, their rent growth is suffering. I think because all of that new supply coming online. Indianapolis is actually the third lowest, at least as far as I have sorted this list in my head here. Third lowest when it comes to the amount of completions of the percentage of total stock. And 2.5 is nothing to, it's not the worst year.
Steady Eddie, Matt. Steady Eddie. Steady, slow and steady wins the race. All that stuff. Okay, one other thing. Again, I love these Yardi reports because they have just some different metrics that others don't have that I like to keep track on. One, always, Matt, is the rent to income ratios as of January 2023. We focus on this decent amount, but come back to the top. Just look at all units. They also break it down. Lifestyle. Again, you were talking about definition of Class A, Class B. Here it's lifestyle units, renters by necessity. Maybe a better way to look at it. CoStar's got a star rating. Anyway, Sacramento, 42.9%. Rent income ratio, Matt. 42% of your income on average, and average is average best, should be median. Anyway, 40% of your income going to your rent should be closer to 30. Anything over 30 is rent burden, so they say. The next is LA, 33%. Now back to Sacramento, though. The renters by necessity, that's the people who don't have an option, have to rent, can't buy a home. That's a lot of California. That's a lot of people in general right now. 59%, 60% of their income just about is going to rent.
Wow.
How's rent control working out for you, Sacramento?
Yeah, it's like double. It is almost double more than double. The lifestyle units, 29.1. Renter by necessity, 59.5. That's such a stark difference.
Matt, you can only have 10 rounds in your magazine. You can't have all the features, and you're going to pay 6% of your income.
Yeah.
You get beaches, you get mountains, you get good weather.
Yeah. It's pretty stark. And Sacramento's not really leading. It's not really leading in terms of rent growth. I haven't really, it wasn't.
It's been pretty well, I think, the pandemic, because everyone's in the Bay Area, but yeah. Yeah, but I mean, you can imagine a lot of places are kind of around that 30% mark. Just a handful are above: Inland Empire, Baltimore, Orlando, Orange County, Washington, D.C., Los Angeles. Matt, these are a lot of markets that have some degree of rent control, if you believe it or not. I don't think Orlando does, Tampa does, although Orlando actually may. I know they were discussing.
Oh, yeah, that was part of the discussion, yeah.
Maybe, I don't think maybe it's just a discussion. Let's go to the bottom now. There's a lot of places in the middle. Affordability, which this Yardi report cites affordability. Indianapolis affordability is a major driver for a reason why it is attracting so many people and so many renters. Kansas City, only 24.6% on average of your rent to income ratio. Indianapolis, 25.2%. Austin, surprisingly, Matt, is not that bad, 25.9%. That's actually
Miami, not so. Yeah,
Miami's pretty good.
Not so bad either. Do
you think that's the issue with average? Do you think because you've got is there a high concentration of billionaires? Like the Elon Musk moved to Austin, and you take the average, and so they're like, oh, everyone's good.
Yeah, I wonder if there's
in Miami, same thing.
Kind of thing. Yeah, it is interesting. I think that the fact that Miami, now this is in another report, but the fact that Miami has not permitted as many housing units per capita as some of these other markets, that may play into it. But Austin's another thing entirely. You'd think that it wasn't an affordable housing market if you were just looking at the amount of rent growth that they're having. I mean, it's a very actively growing city, and it's interesting to get that reminder that
the renters by necessity column does tell a little bit different story. I mean, Austin's at 28%, which is a little bit higher, still under 30. But Miami, though, it's the big difference between the renters by necessity and by choice, where it's 36% for renters by necessity. So it's a really tale of two cities versus the renters by choice, 23%. So 23.9%, incredibly low.
Yeah.
So I think there's a lot of money in Miami, and then again, I don't know if that's everything, but that certainly could be part of it.
Yeah, only LA and Sacramento that we've already discussed, only LA and Sacramento have a higher percentage of income for renters by necessity that they're paying on their apartment rents. That's interesting.
Yeah, yeah.